Hey guys, welcome back to the Patty Martin Real Estate Group YouTube channel. My name's Adam Wachtel, and we are joined today with a mortgage broker, Mike Slater. You're back on the show here today, Mike. Nice to see you.
Adam, thank you, buddy. It's greatly appreciated. Great to be back on the show.
Awesome. So today we're talking about investment properties and the financing that you need to get into an investment property and how we can kind of set that up and use it for to supplement your income today, but definitely to supplement your income for retirement. I mean, an investment property, we're not talking about flipping here. We're talking about buying something, holding it, cash flowing it, and slowly climbing that ladder so that you can earn more revenue throughout the years. But to start off and to give us kind of perspective here, I found this very interesting article, and it was published in February 2023. So it's very recent, but it's from a census done in 2021, and the information is actually from 2020. So the numbers have shifted a little bit, and I'm sure they're a little bit higher now. But it gives us perspective on how many investors there are in the Canadian real estate market, but definitely the BC market. And the title of this article is "Nearly a quarter of all homes in BC are owned by investors." That's a lot of homes that are owned by investors. So we can tell that this is a very popular vehicle for speculators, for investors, for people that are trying to grow their portfolio and kind of have a stable source of income in the future. So this census was done for 5 provinces. It was Nova Scotia, New Brunswick, Ontario, Manitoba, and BC. And what they looked at were investors of 3 types. So they have the primary investor, who's like a speculator, somebody buying their secondary residence, Airbnb people, developers. Then they have investor occupants and then non-investors. So those are people that own their homes and don't rent out any spaces and don't have a secondary property. So what it said here is that in 2020, approximately 23.3% of residential real estate owners in BC are investors. So that's people with at least one property that is not their primary residence. And nearly 10% of those investors are investor occupants. So those are people that have, a house with a basement suite or a laneway or something of those sorts. So that 10% that is owner investor is actually the highest amongst the 5 provinces, and it's more than the 4 other combined. So in BC alone, you have more investor occupants than pretty much anywhere else in Canada, which I found not too shocking given the price of real estate in BC. What do you think about that, Mike?
Yeah, I think you've pretty much nailed it, Adam. The reality is it's based on house pricing and kind of government stipulation around those owner-occupied with investment and or investment vehicles. Whereas going back 18 months, 2 years ago, it was really hard to use rental income from a rental suite that wasn't authorized. And then BC took the stage and moved that ahead because the reality is pricing just ran away.
So do you think, is that true for the other provinces as well? Or is that a rule that's kind of mandated in BC that unauthorized suites, you can't really use the income for financing?
Well, it's not I think it's pretty much here in Ontario. I'm not sure about East Coast. I mean, it's not to say that we haven't financed a number of properties there. They put so much emphasis on how the appraisals were written up as to define that rental space, meaning it has its own kitchen, it has its own access, it has windows in the bathroom, like certain stipulations. And so I think once the appraisal companies came aboard and motivated how that rental suite came together, there was more justification behind it.
Interesting. So, like I just said, about 10% were investor occupants, and that's the highest amongst the 5 provinces. Like the other provinces, like Manitoba, 0.7% were investor occupants, 0.8 in Ontario, which I found shocking because their prices were climbing quite rapidly. New Brunswick was 2.5%, and Nova Scotia was 1.5%. But this is the thing that threw me for kind of a whirlwind here, and is that BC didn't have the highest percentage of investors of all the provinces. In fact, there were more residential real estate investors in Nova Scotia at 31.5%. Remember, BC is only at 23 and a bit. Um, New Brunswick was 29, Manitoba was 20.4%, and Ontario was 20.1%. So I found it interesting that of the Atlantic provinces where housing is a lot more affordable, there's roughly 10%, 7 to 10% more investors in those provinces.
Yeah. So I think the reasoning behind it is because BC is obviously, it's West Coast, it's the best province across Canada in terms of climate. We're not being biased because we live here, but climate being one of it, proximity to travel, international travel, and the reality is the makeup of the generic buyers within BC. And so I think while the government stipulated that they were trying to stop people essentially parking their money inside of the province, they didn't do anything to kind of limit that foreign investments. So they slammed the brakes on from January 2023, saying no foreign ownership. I think the reality is that it's so much more desirable. I'm not saying it's not desirable back east. It's just the generic makeup of the demographics on the West Coast. It's kind of almost like a safe haven. It's, like you're guaranteed. We were seeing increments of incremental growth in the value of the property. If you look at it back east, where those houses were way more affordable, they kind of growth at 2 or 3%. If the average home back east was, say, $300,000, the average home in BC was $1 million.
Yeah.
Both escalating at 3%. If we took the norm, well, the reality is, where is the growth?
Yeah, that makes absolute sense. You're going to get 3% on $1 million is a lot more than 3% on 300,000.
Yeah.
Even though it's still 3%. This is the last stat I want to throw out that was, actually there's two more, but this was pretty interesting because it coincides with what you just said, is that in BC, in-province investors accounted for the highest proportion, and that's 18.1%. So people in BC are investing in their own province. And then this is the last one. So all in all, 36.3% of condos in BC are owned by real estate investors. So 36.3% of condos are owned by investors.
Right.
And that doesn't say non-resident or whatever. It's just owners of investors of condos.
Yeah. Well, I think also if we look at the structural makeup of real estate that comes into the market at any given point in time, condos, obviously, because the developers, multiple units based on the same footprint as building, 4-family homes, how many units can you put up? So,
oh yeah, it's definitely
makes
more
perfect sense. Yeah.
Yeah, absolutely. So here's my question for you, Mike. What are the requirements to qualify for a mortgage for an investment property as an individual borrower? So I'm not a corporation. I'm not a sole proprietor. I'm just an individual who gets the T4. What are some of the requirements that we have to look through?
So it's interesting that across the board, the fundamentals of underwriting a mortgage are pretty much similar right across the board, whether you're an investor, whether you're incorporated, not incorporated, sole proprietor. It's the fundamentals of underwriting a mortgage are based on income, debt service ratio, the income that's produced from the rental suite or rental unit, and all of that is factored into the application. When you go into a holdco, it's more about the tax structure associated with the investment, and you also obviously limit the financial institutions that have the ability to finance in that holdco and or operating company environment. Because if they do that, typically it's funded through their commercial divisions, and their underwriting is also very different. It's like there's a total different process associated with it. It's a little too deep to go into right now. But in terms of underwriting a investment property, it's same as you buying your principal residence. They look at your credit, they look at your income, they look at the debt servicing ratios, and they look at your fallback position. So it's also client profile plays a huge, huge position in it, because the reality is every lender across the board will only use typically somewhere between 50 and 80% of the rental income as part of your qualifying income, because they've got to factor in, non-payments, default, people neglecting to actually pay and vacate the property or not vacating the property, so delinquency. So all of that kind of gets factored in. So investment properties,
Does that get factored in? Does that get factored into the amount that you're approved for, or like your interest rate? They give you a higher interest rate because you're more risk.
um, both, but more so about what you're qualifying for right now. Typically on a rental property, the idea is the institution, well, and I don't know if it's the institutions per se or it's coming down from the regulators. They're saying that you're using banking money, and typically they're kind of treating it as a business, because in essence, you're buying an asset, you're getting a rental income, you're servicing that debt with the rental income. So
Yeah.
I think it's trying to reel all of that in, and it is most certainly still about the affordability, so that debt servicing ratios. And in a rental environment, typically most of the lenders will bonus up the rate, typically 10 or 15 basis points, because it's treated as investment income in their minds. So if we're lending you the money, we should be paid more for it.
And that's the same for just your typical person who has a T4 buying investment property, or your corporation having that investment property.
Yes. It depending where it's funded, depending if we take it through that commercial environment, because then it's all about the fundamentals of the financials. So in a typical T4 environment, you're using T4 income. That's the income that's declared on taxes. Whereas if you're in a corporation, typically you've got most people are essentially T4ing themselves. They're keeping a portion of that income as retained earnings inside of their corporation. Tax purposes, once again, a tax shelter, you're paying at a much lower rate on those funds held there. And then people typically also inside of that environment will generally dividend themselves.
Right.
So they're taking a portion of that dividend income. And as long as the dividend income is declared for the last 2 years prior to the actual application, so then all of a sudden you have dividend income, you have T4 income, plus you have retained earnings. So the ability to borrow more within that environment is somewhat better set up. But at the end of the day, the lenders are still underwriting the mortgages based on your financial profile, your overall financial profile. So
right. So in today's environment, I mean, we know that recently you've helped people get into their principal residence, and they've kind of qualified at a rate of around 5%, which is down from even a couple months ago, which was 6%. But there's the stress test. So these both we'll call it the owner, I guess, we'll call it the corporation. So if a corporation is trying to get an investment property, are they still stress tested the same way as the individual?
absolutely.
Okay, so both parties are still qualifying at about 8 or 9% to essentially get an investment property.
Yeah, it's 2% contract rate or 2% above, whichever is the higher. So if the contract rate was 4, it's 2 plus, it's 6. So yes, but in that not corporation, but business environment where they're bonusing up their income, you've got an extra 10 or 15 basis points on top of. So instead of it being at 2% above the 4, it's 2.15. So 8.15 versus 8. So
well, there's stress tests, right? So I guess that again, it's the bank's protecting people from themselves, because yes, it happens often where a tenant doesn't pay, they stay in the property. Now the investor is actually on the hook to pay that mortgage. So, I mean, we can talk about what you kind of need to keep in the bank as a safety net, but that's kind of another topic for here. With whether you're buying an investment property as a corporation or an individual, what kind of down payment do you need, and does it differ?
So as it stands right now, if it's conventional financing, it is 20%.
Okay.
As the minimum requirement. But inside of a investment environment, as you alluded to, it's about fallback position. It's about the client's ability to carry the debt if there's a delinquency or non-payment. So as long as there's a little bit of a cash reserve, and that's where you build into your formula, you can show the lender that they're not going to tap into their RRSPs, because they're already going to take a 35% hit on taxes to be able to service that debt. So it's typically cash, really accessible cash in the bank, and or investments that you can tap into that don't have as big an impact, financial impact, tax impact, location to withdraw it. So it's more about the client profile.
So here's one of those things that I've been thinking about because, I deal with a lot of first-time home buyers, and housing affordability in BC is it's not easy to buy your first home without help, or unless you're making a few $100,000 a year and can seriously save for that down payment. So in one of the numbers that I just rattled off there about the investor type in BC, one of them was investor occupants. So BC has the most investor occupants of pretty much anywhere else in Canada. We're at 10%. If I was to come to you, Mike, and say, hey, listen, I'm buying my principal residence. I am going to live in the property. There's no lie. We're not lying to CRA. We're not lying to the banks. I'm going to live in the property. We know that you can buy a property with as little as about 5% down. And then it kind of there's a ladder there once you get into the higher thresholds of pricing. Do you understand what I mean? Like it's 5% on the first 500,000, and then what is
5% first 500, and then 10% up to 999,000.
Okay, so what is
essentially off an insured cap?
Right. So let's say we found a property 800,000 or so. We know that we need 5% on the first 500, up to 10% between 500 and ultimately $1 million. Okay. So we can get into a property for about somewhere between rough math, 7 to 10%.
Mm-hmm.
Okay.
Right.
Then once we are the owner occupant, it's our principal residence, we could rent out the other bedroom, let's say.
Sure, absolutely. But you're not using that income to qualify for the mortgage, because essentially you're talking about some form of a student housing environment and or foreign student participation. So where you are actually deriving an income, and you can't use that income to make the next acquisition, because in essence, the home's not set up. So you can't use partial income and or non-declared income as income for qualifying for the mortgage.
Right. But this could be a way an individual actually gets into an investor environment, not so much a corporation, because you can't be a corporation being like, I'm buying this as a principal residence, and then, there's different rules around that.
Yeah.
But as an individual, instead of saving up, let's say our purchase was 800 grand and 20% is the 160,000. So instead of saving up 160,000 for that 20% down payment, I could save up, let's say 75, 80,000, get into that 2-bedroom, have somebody rent out that second bedroom. Hopefully it's a close friend. Ultimately, let's say they're paying half of your mortgage,
right?
That could be a way to start, one, not only get into the real estate market, dip your toe in as a beginner investor to learn how cash flows and tenancies and things like that work, pay off your equity or build up your equity in your house because you're paying off your mortgage. And then hopefully from there, after you build up enough equity, you sell that home. And then, you can do whatever you want, or we could refinance potentially and take out that full 160,000. And now you have your primary residence, and then you take that 160,000 line of credit for an investment property, and not to go buy, cars and whatever else, like material item. And I have a tenant paying back that line of credit, then that's tax-free money that I'm using to really put back into the market, earn equity, earn rental income, and eventually fund my retirement.
Absolutely. Makes perfect sense. Because, and in essence, from a lending or underwriting process, as long as we're defining that debt overall and the ability to service the debt, then absolutely, like that is a doable scenario. But could that change? Potentially.
There's the key.
Right
now, you mentioned off camera that some of the requirements for an investment property are about to change.
Well, the talk is there. The financial regulator is trying to not manipulate, that's not the right word, but more hold back to create more inventory for the marketplace. And the reality is it's about supply and demand, and it's about affordability. Like we discussed, West Coast, the real estate just appreciates in value based on position, geographic location, and demographic makeup. And there's a lot of money back in the West Coast. There's a lot of old money that's established, and a safe haven is a hope, because the reality is it's not going anywhere. It appreciates if we just take a flat rate of 2 or 3% a year, year over year. It's a safe vehicle. You don't have to speculate and watch what happens within the marketplace. The stocks go up, stocks come down, bonds go up, bonds come down. Real estate, even when they taper off, as they did for the last couple of months, it was all based on affordability, number one, but also stress related to rates increasing as quick as they did in such a short period of time. We're back in normal rate environment. If we go back 20 years, rates were in the mid fives. It's not unrealistic. So to think that market requires stability, and as soon as there's a sense of stability again,
people rush back to it.
Exactly. Yeah.
Because real estate's more tangible. You're actually touching something physical.
Yeah.
When it comes to an investment property, is there anything else that you think the individual or the corporation should really consider while they're getting their qualifications in place? We're not talking about the property. We're not talking about cash flows. Just, is there anything that they should be considering before they jump into an investment property?
I think the individual just needs to hold in mind that they've planned the financial profile. So they understand they're making the purchase. They understand the risks associated with that second purchase. And it's the same as going to the stock market. You buy stocks, some are good, they go up, some are bad, they go down. So it's based on the actual property, number one. And so appraised value, return on your investment, and the overall financial structure of that investment property. So buying into an older building, for example, that's going to have a bunch of money that's required within that. So it's all about the due diligence. That's what I'm coming down to. It's about due diligence. The reality is it's a safe investment vehicle no matter what. As long as the debt is being serviced over a period of time, the reality is closer to retirement, you've mitigated the outstanding mortgage balance, and then the income flows directly to you.
Yeah, so that's exactly right. I guess one of the things I was going to say, because you commented on, it really depends on the property, is that even if the market does fluctuate, so we have a period of high interest rates right now, as the investor, as long as we can, for the most part, cash flow it, or even if we have to supplement it a few $100s a month for a short term, if it's not a good time to sell it, don't sell it. Like, markets will go up and down in Vancouver as well. And if you can just hold it for that period where it's just a little tougher, kind of like it is right now, hold it. Because 10 years down the road, we just don't have the supply to keep up. Like, we need to build over 100,000 homes a year just to meet equilibrium. And that has to be the right type of home, not to mention just condos or, townhouses. That's a hard conversation to have with the city and the builders. Last question for you, Mike. About 2 decades ago, a lot of people would buy a pre-sale. They'd wait their 2 years, they'd make their 10%, they'd cash out and just jump to the next pre-sale. So if we're looking at getting financing for an investment property, would you say it's harder to get financing for a pre-sale? Should buyers be looking at something that's already on the market? What's your input on that?
Okay. So my suggestion in that investment environment, when you're speculating on the market, and the reality is you're speculating on a relatively stable market, regardless of pricing coming off and going back up, the window is so short, because you nailed it. The issue is supply and demand. I'm not sure how we'd ever meet those expectations of delivering 100 to 140,000 units a year to exceed market availability and then cap or reduce pricing increasing.
Right.
So in terms of pre-sales, some lenders will do a pre-approval up to 18 months in advance. The reality is they're going to capitalize on it, because if the rates are 4%, they're probably going to do it at 6.5 or 7%. Okay. And then your stress test is 7 plus 2, it's 9.
That's pretty high.
That's really high. So that's one aspect. But if the window is really short, if the window is 8-10 months, then yes, maybe it makes sense. And then hopefully that the market has come off and the rates have come down, and at closing, the actual payment and the rate is a little lower. The other way to do it, which I've done with a number of investment guys, is they've got to feel comfortable that you need an alternative financing source, so a private lender or a MIC.
Sure.
And so the ability to actually close. So yes, it does carry a higher interest rate. Yes, it does carry a lender fee. But the reality is we don't necessarily have to go through the same stress environment because it's not stress tested. It's exit strategy for the lender. They just want to know that, yes, they're going to be putting up the money. Yes, they're going to be putting up a lot more money up front, but they want to be able to exit that strategy and not put the client in a financial mean where they're not able to get out of it. So some of the guys that we've done this with, or some of the investors, we get them into a private environment. And then after closing, we wait to see what the actual appraised value is, because that's the other issue.
Yeah.
Purchase on a pre-sales today, it's list price. And some of the lenders have been told, no, you can take the lift or the increase in value. You've got to take the original assigned value at the time of purchase.
Oh, interesting.
Right. And so right now, when rates climbed as quickly as they did, it put a whole bunch of stress because all of a sudden the values weren't coming in at appraised value. So it's not that the clients didn't qualify. The clients were fully qualified, but the lenders were saying, well, it's appraising at a lower value. So in essence, they can force the buyer to put more money down. Perfect. So getting into a pre-sale is great as long as you have a strategy. And the idea is formulating a strategy, even if you have a fallback position. I have other clients who get a line of credit on their principal residence, hold that as a cash reserve, still make the acquisition. And even if they're not debt servicing, you're like cash flow positive, they're servicing it out line of credit.
Right. That thing we just talked about where it's a couple $100s a month, you're just going to float the property until you can get into a better environment for your investment.
Exactly. Yeah.
Awesome, Mike. That is a lot of very useful information. I think we will end it there. And I appreciate you coming back on the show to share all these insights.
Fantastic, Adam. Thank you. And I appreciate being on with you today.
If you guys want to get in touch with myself or anybody from the Patti Martin team, there's going to be a link in the description below, as well as Mike Slater's information. He's a useful guy to talk to when you want to get into an investment property. So we'll make sure we connect our listeners with you, Mike.
Great. Thank you very much.
Have a good day.
And you bet.